How's it going, everybody? I'm the BTC Reaper, and my goal on this channel is to teach you how to reap the rewards of trading, whether price is going up or down. So this is going to be our trading pattern video that I know quite a few people have been waiting for, so we'll get right into it. Here's a picture of the graphic behind me. We have some bullish patterns and bearish patterns. These are the continuation side, these are the reversal side. Continuation means that if we're bullish and a bullish continuation pattern comes up, that means we will continue bullish action. If we're bearish and a bearish continuation happens, we will resume bearish momentum. Reversal patterns, however, are like bottom or top indicators that would indicate that we're going to go the opposite direction. So we're falling and you see a bullish reversal, odds are we're going to start going up. If we're rising and you see a bearish reversal, odds are we're going to start going down. So now that you understand the difference between the two sides of the chart, we're going to look at both patterns, the bullish and the bearish version, and compare how you would enter or exit them when you're trading. So our first one is the ascending and descending triangle. The ascending triangle is bullish, ascending goes up, descending is bearish, descending goes down. So your entry would be based on your breakout zone. So for the bullish pattern, your breakout would be a positive breakout. You'd want to break above your resistance. So your entry would be just above that resistance where you'd want that breakout. And your entry would be just above this previous point. If you see, you get 2 points to the top, 2 points to the bottom, and then usually they'll break out. Sometimes you might get like a third or fourth, but if you get slightly in there or above, that's a decent entry point. Your take profit would be your measured move from the top of the triangle to the bottom of the triangle where it opens, and you put that out like we do on the videos. You won't want to take the full take profit. Like we said previously, if you try to take the full move, odds are you might not get any move. Your stop loss, which would be this red zone, would be just under this second touch here. That way, if you fall below a normal level, you break your pattern, you're out. You want to worry about holding way down here if we break way down. So for the descending triangle, your stop loss would be on the bullish side above that second touch, and your entry would be below that support level on the second touch for a short. It wouldn't be buying shares. Buying shares, you'd be waiting for these bullish reversal patterns. So a bullish wedge is a continuation. Your entry would be at that second point, similar to how this ascending triangle would be at that second point there. And your stop loss would be just at the bottom of this opening of the wedge. That way if you break out of the wedge and start falling down, you aren't holding. And your take profit would be top to bottom of the pattern. That's pretty much how most patterns are measured, except for these following two. So these bullish and bearish flags, you measure them from the start of the drop or rise to the top of the flag, and you put that on the end of your flag for your take profit level. Your entry would be on just at that third touch, because you see we normally get 3 touches, on the fourth we normally break out. Your stop loss would be just under that third touch to the bottom. That way if we get rejected and come back down, you aren't stuck holding if we break out of the pattern. However, that if you're in a falling bullish flag like this, you might get stopped out a little early and get stop loss hunted. So that's one risk you have to take when you're taking your trade, and you'll have to kind of evaluate if you want to move your stop loss or not. And then these symmetrical triangles are the pattern that we're fighting with currently, and these are like a 50-50 bullish bearish. That's why both patterns look very, very similar. If you want to get in for a bullish move, your entry is going to be just above that second point to the top of the triangle, and your stop loss will be just below that last point on the bottom, which would be the second or third. And it'd be reversed for the bearish triangle. You would measure the take profit similar to a bear flag if it's coming from like a pendant like we are, or if it's just for this triangle, you take half of the move of the triangle. You don't take the full move for this pattern. Now that's a little bit of how you read this. So these reversal patterns that would change the direction of our pattern instead of continue the direction. We have our double bottom and double top. These you usually get a low followed by the same low, and then you'll go up, typically to where you broke down from, and your entry would be just above that where you came like bent for that second touchdown. And then your stop loss would be just above here, although I'd probably have mine somewhere up here just to be a little more cautionary depending on the pattern or the circumstance. You'd have to see how your indicators are looking. And your double top would just be flip-flop upside down, so your stop loss would be just above these points or below these points, and then your entry would be below where that touchdown that we rose up from to make the second top at. And then your take profit would be where you're coming from. So if you have like a bunch of sideways action, then you pop up, your take profit would be where that sideways action is starting from, or wherever this pattern broke from. The triple bomb, triple top, just like the double bomb and double top, except has an additional touch. You don't really see those quite as often. With crypto, you'll see them, as normally there's 3 highs in a cycle. However, that'd be more like a slanted double top or double bottom, because usually it's new highs and new lows. So it's not really these reversal patterns. That's how it's different, even though it's a similar type of pattern. Now, head and shoulder and inverse head and shoulders, these work similar to the double top and double bottoms. However, you'll get a short low followed by a lower low, and then you'll get a similar low. You can see these slanted kind of often, so your other low might be higher than your first low. But if it's not a slanted one, usually those 2 lows are right around the same point. And then you take your neckline down to your head, and you'd measure that to the top of your neckline for your take profit level. Your stop loss would be just below those shoulders, or above the shoulders if you're doing a short. So the wedges that we have can also be a continuation or a reversal pattern. You can see them here and you see them here. They just have a little different angle as they're represented. They don't always have to have this exact angle. They can be a little more flat. However, if it's too flat, one pattern, that would be more of these ascending and descending triangles where you have a flat spot. So that's the difference between these patterns. Your take profits and entries would be just pretty much the same as these ones, except you're not dealing with quite as much of a slant. Thank you for watching this video. I hope you have a great day.